Imagine two friends, each with $10,000. One invests it all in the market on a single day. The other spreads it out, investing a little every month for a year. 5 years later, one of them is noticeably richer. Which one do you think it is? The answer isn't as simple as people online make it sound. Let's break it down. A lump sum investment means putting your entire amount into the market at once. The advantage is simple.
Your full amount starts growing immediately. If the market rises, all of your money benefits.
The risk. If the market drops right after you invest, your entire amount takes the hit at the same time. SIP, or Systematic Investment Plan, means investing a fixed amount at regular intervals, usually monthly, instead of all at once.
Its biggest advantage is dollar cost averaging. Since you're investing regularly, you buy more units when prices are low and fewer when prices are high.